It's Friday, 14th of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, as Europe prepares to slap tariffs on Chinese EVs, why this approach is different from the US tariffs just a few weeks ago, and OPEC versus the IEA, who's right about peak oil demand. But first, Neil Shearing, Group Chief Economist, joins me once again for a look back and a look ahead. Hi, Neil.
Hi, David.
Busy week, with lots to get through, but let's start with the Fed and the June decision. We had that May CPI data that came out just ahead of the announcement. Felt like a bit of a contrast with the rhetoric that came from the FOMC. Talk about where we are on the inflation front and why the FOMC doesn't seem to be more amenable to easing policy at the moment.
Yes, that's right. Two critical developments on the monetary policy front in the US over the past week. That May inflation data, CPI data, and then the FOMC meeting. Let's start with the inflation data because I think that's the most important. The key point there, of course, everyone's focused on the headline rate being flat month on month, but the core rate coming down. And actually, the most important news over the past week has been potentially in the PPI data because that forms an input into the PCE inflation numbers. You're keeping up, there's an alphabet soup of inflation data here. But the PCE numbers are what the Fed looks at. And in particular, it's focused on core PCE inflation. It's the PPI numbers, the producer price index numbers that feed into the PCE numbers. And that, on our models, our modelling, is projected to show, on the basis of the PPI inputs, a core PCE number of just 0.1% month on month in June. So there's substantially better news on the inflation front for the Fed over the past month. That wobble that we had at the start of the year, we had these podcasts and we said, well, don't read too much into 1 or 2 months data. And it seemed to be kind of one or two things: motor vehicle insurance, healthcare, shelter, contributing to that stronger inflation data at the start of the year. Those items seem to be fading, and there's been better news in the past month or so. That gets you to what does it mean for policy? And of course, we had the FOMC meeting, that new projections showing only 125 basis point cut this year set the cat amongst the proverbial pigeons. But I think it's worth digging a bit deeper into what those projections actually show. And actually, it was a relatively close run thing. So 4 officials expect no cut this year, 7 anticipate 1, 8 look for 2. So actually, if you look at the kind of modal outcome, there's more officials looking for 2 cuts than there are no cuts or 1 cut. And it's the way that the median works. Obviously, it's the median projection is a 25 basis point cut. So the outcome of the FOMC, I don't think it's quite as hawkish as some have interpreted. And I think given the progress that we've seen on inflation in the latest data, if that's sustained for 1 or 2 months, then I think a September rate cut is very much on the table.
There's another meeting at the end of July, though. I mean, if we get another benign print in June, and if some of the activity data continue looking a little bit soft, do you think that will fuel speculation that July could be the start?
Possibly, but I suspect it's a bit too soon. I was in the US earlier this month with Paul Ashworth, our chief US economist, talking to clients, and the mood was really gloomy. And then we got the May payrolls number. I think that's helped to lift some of that gloom, the idea that the US economy was teetering on the brink of a marked slowdown. And so given that the real economy, I think, seems to be, it's softened, but it's not collapsing, I think you would need to see, to get a July cut, you would need to see not just more soft data, but you would need to see strong evidence that the real economy was weakening substantially. And at the moment, that doesn't seem to be in the offing. So don't rule it out entirely, but I think it's pretty unlikely. And to the extent we get more than 1 cut this year, I think September and December is more likely than a July move.
So a US inflation release straight into a policy meeting. This coming week, we've got a similar setup in the UK. Inflation on Wednesday, Bank of England on Thursday. Given what we saw with UK April inflation data, could May CPI be another disappointment? And what are we expecting from the MPC?
I think if you look at the headline measure of inflation, I think there's a good chance actually it drops below its 2% target in May. That's what we're penciling in. But of course, it's the core numbers, and in particular the services numbers, that the Bank of England is focusing on. So I think there probably will be a bit more progress there. We're forecasting core CPI dropping to 3.2% in May from 3.9% in April. Services inflation coming down from 5.9 to 5.3% year on year. But they're the numbers to watch for. In the April data, there was that upside surprise. And of course, we've subsequently had some pretty strong wage growth in April too. I think the key issue there is the extent to which a big increase in the UK minimum wage in April is playing into both the wage data and also perhaps giving some support to the price inflation too. The May data will shed further light on this. But if we start to see services inflation, core inflation ease, I think it's unlikely that we see a move at the coming week's MPC meeting. But it's still possible that we get a move at the August meeting.
This coming meeting is going to be the last one before the general election on July 4th. Does that have any bearing, do you think, on the bank's decision? And actually, given the rumblings from the Trump campaign and the briefings against Jerome Powell, talk a bit about whether November's vote in the US figures into FOMC deliberations between now and then.
Well, possibly. I mean, maybe at the margin, if you thought that it was a pretty close call and if there was a sense in the market that the central bank was vulnerable to political pressure, then I think at the margin, if you're a policymaker, you might hold off. But I don't think that is a big consideration for the Bank of England. I don't think it's a big consideration for the Fed either. They're going to remain squarely focused on the incoming data. They've told us that, and I think there's no reason to doubt that. And it just so happens that in the case of the UK, I don't think that supports a rate cut in advance of the election, but it might do shortly after. And in the case of the US, as I say, a September move is still possible. I guess the one advantage to waiting and seeing how the election plays out is that central banks get a better sense of how fiscal policy might look after elections. And of course, as we've talked about on this podcast before, fiscal policy has been key reason why the real economy is held up, but on both sides of the Atlantic, a bit better than expected in the face of higher interest rates. So I think that there's potentially some benefit to waiting and seeing, so you get a better sense of the fiscal landscape, but I don't think it's a big driver of decisions at central banks.
Let's stay on elections because Emmanuel Macron has added another one to what was already a very long list of votes this year. Parliamentary election called in France after that European Parliament vote. French politics in turmoil, bond yields are surging. Now, as a couple of Brits, we are in no position, are we, to cast aspersions? Liz Truss is no distant memory. But, I mean, given the state of French debt, how dangerous is this moment?
Well, from a political perspective, I think it's seismic, and I still can't quite fathom the decision to call early elections in France, if I'm being honest. From an economic perspective, of course, I don't think it changes the immediate outlook for France, not least because Macron will remain as president. It makes fiscal consolidation that's important less likely. And of course, that's part of the reason why we've seen this adverse reaction in bond markets. But I think it also speaks to a broader shift towards populism, potentially in European politics. And I suspect in bond markets a concern about what's going to follow in France in the 2027 elections, given some of the early opinion polls suggesting a big shift towards the populist right party RN in the forthcoming parliamentary elections. So it's really all about fiscal policy, this. And as you say, France's deficit's large. It's substantially larger than was the case before the pandemic, and the debt load is large too. I think one important point to stress is that there's very many different political outcomes here. And even if RN get into power, and even if they win the presidency in 2027, which is a long way off, we've seen, of course, from Italy, that Giorgia Meloni in government has been far more moderate than was the case on the campaign trail. And it's notable, actually, that there's been no real move in Italian BTP yields over the past week. I think the second point that's worth stressing and really important is that the monetary architecture in the Eurozone is fundamentally different now than was the case at the height of the Greece crisis and the Italian debt crisis last decade. In particular, the ECB much more willing to stand behind national bond markets, and it has the policy tools to do that. So it has its OMT program that it could use if fiscal concerns were to cause serious dislocation in the French bond market, although that would require an official program, as it were, from Brussels, a kind of bailout program. There might be some resistance to that. It also has its TPI, so-called TPI program, that would allow it to purchase bonds of other Eurozone economies as a result of any dislocation in the French market. So, for example, if the Italian bond market was to start to sell off because of concerns about what was happening in France, the ECB could use its TPI program to purchase Italian bonds in the secondary market and ease those strains. So the monetary architecture is very, very different in the Eurozone today than was the case 10 years ago. And I think that reduces the risk of a systemic crisis.
But this is all, as you alluded to, part of an advanced economy theme, isn't it? We've been holding spotlight events in the past few days, which are annual events around the release of a major in-depth report and interactive data dashboards here at Capital Economics. The theme of this year's spotlight is about whether US economic outperformance will continue. And it takes in everything from Chinese imbalances to AI bubbles. And as part of the release, we've been taking questions from hundreds of people in the market across the world. And what I found striking was that the same question kept coming up over and over again. And it was along the lines of whether the US fiscal situation poses a threat to US global dominance. So talk a bit about that idea, talk about the risk that the debt situation in the US poses, particularly to the US role in the global economy.
Yes, so as you say, our Spotlight report looked at what I think is perhaps the most important issue facing investors over the next year or so, which is what's behind US economic outperformance, this US dominance to the global economy. Can it continue? We looked at it both through an economic and a market angle. And the conclusion essentially was that US economic dominance at a global level will continue, partly because the US will continue to perform relatively well, but also because some of its peer challengers will fall short in one or two key areas. Now, as we presented this to clients, and indeed there's a whole section in the report that looks at the fiscal situation, a key question that's come back to us is, yeah, it's all very well and good, but there's this dire fiscal situation in the US. How does that play into the view? And I think it's important, it's absolutely not to diminish the fiscal risks in the US. But the key point from the long run is productivity growth. Productivity growth is absolutely critical for the long run economic growth. So if you're thinking about what's going to be the fastest growing advanced economy, the dominant economy globally over the next decade, it's really all about who's going to see the fastest productivity growth and will it keep that economy at the frontier. And our judgment in the case of the US is that for various reasons it will. Now, a fiscal crisis and the fiscal situation, I think, is much more of a kind of short-term issue. It's substantial, it's really significant, and the US needs to tighten fiscal policy. There needs to be a substantial tightening of fiscal policy in the US. And in turn, that will help the Fed start to lower interest rates. But that's much more about the balance of demand within the economy. There needs to be a rebalancing of demand away from the public sector and towards the private sector. Whereas productivity growth is much more about the supply side of the economy, the ability of the economy to deliver and produce goods and services. So in the short term, absolutely, there are big fiscal risks. But that's an issue principally, I think, for 2, 3, 4 years. And there's still a way of dealing with this, which is kind of gradual sequence fiscal tightening. The long run path of the economy is much more about the supply side and productivity. I think another point that's worth stressing is that our report's about the kind of relative standards of economies. And these fiscal concerns are true across all advanced economies. They're particularly acute in the US, but then the US has a bit more cover given that it has the global reserve currency and the exorbitant privilege that goes with that. But when we're thinking about the kind of relative performance of economies, all advanced economies need to undergo a period of fiscal retrenchment. So it doesn't necessarily alter the story about the US vis-a-vis the rest of the world, even though, because all economies globally need to undergo this fiscal consolidation.
Neil Shearing there on the US fiscal position as a threat to its global economic dominance. The Spotlight project, including the interactive dashboard, is available now at capitaleconomics.com/spotlight 2024. But I'll also link to it on the podcast page. It's by far the most viewed part of our website in recent days. So take a look at that. On France, we held a drop-in, which is one of our short-form webinars, just after the European election results last Monday. We're going to be briefing again in the coming week on what to expect between now and July the 7th and what's happening in the bond market, so stay tuned for details of that. I'll also add our latest written analysis on what's happening in France and with French bonds in the podcast page as well. On central banks, our UK, US and Europe teams are going to be online shortly after that Bank of England decision on Thursday for a drop-in to take your questions and highlight key takeaways. Doubtless they'll be discussing the divergence between the ECB on one hand and the Fed and Bank of England on the other. Look out for our UK inflation coverage the day before, and we'll also be covering Japanese inflation, Chinese investment, retail sales and industrial output numbers, US housing data, and the flash PMIs in the coming week, just to name a few of the releases we have under coverage. There's a calendar on site which has previews of all of the events and data releases that our economists think you need to be paying attention to. You can find that under the resources section of the website, but I will link on the page to that as well. Bookmark it and you'll be prepped for the week ahead. Now, a few weeks ago on this podcast, we were talking about US tariffs on Chinese electric vehicles and other goods and what they signal about a fracturing global economy. Well, in recent days, it was Europe's turn with announcements of threats to raise tariffs on Chinese electric vehicles of up to 40%. Is Europe following the US strategy? How will China respond? And what does this all mean for Sino-European relations? Andrew Kenningham, our Chief Europe Economist, has been following this issue closely, and he sat down with Mark Williams, who leads our Asia coverage, to talk through what's just happened. Here's that conversation now, and it starts with Andrew explaining what the European Union is trying to achieve.
It's actually quite a good question because they're not trying to completely prevent China from exporting EVs to Europe in the way that I think the United States is. In fact, they've set the tariffs at a level which means that most of the companies from China are still going to be able to export. The larger ones like BYD are having to pay around about 20% tariff, when that leaves them a significant profit margin still. So it's not going to prevent the gradual increase in the number of Chinese EVs entering the market and the potential reduction in European companies' market share. But I think European authorities are trying to sort of at least send a shot over the bows that they are concerned about protecting their own market. They may hope that this will slow the pace of increase of imports. And they may also be hoping that it will encourage Chinese companies to relocate some of their production into Europe rather than exporting. So investment rather than trade.
Yeah, that makes some sense. So just before we started speaking, I had a quick look on the websites of BYD in China and Germany, and looking at like the BYD Seal, which is one of their models, retails in Germany for about 40 to 45,000 euros, depending on the model, the trim that you get. The equivalent models in China are about 20 to 25,000 euros. So in partly that just goes to show that right now the margins that BYD is earning selling these cars in Europe is huge. Mm-hmm. And as you say, it suggests that they can absorb all of the tariff. And the tariff that they're being hit with is one of the lower ones, isn't it, for BYD?
Yeah, I mean, the media focused a little bit on the top tariff that was applied, which is 38%. And then on top of that, you have the 10% that was already being charged. So it's nearly 50% for SAIC. But that's a rare case. That's a company where they said that the Chinese had not cooperated with the investigation. BYD, I think, is paying 21%, and Geely is 17% or so.
Yeah, so I mean, SAIC, they own lots of brands, but one of them is MG, and they've done quite well at the low end of the market. So I guess for them, it will be more restrictive because they're overall now paying an aggregate tariff of getting on for 50%. So they then have to make a choice as to whether to raise prices or sell at a loss. And it did strike me that they might actually think that, selling at a loss, they might think that might be the thing to do for a short time because they're trying to build a footprint in this growing market. And so
that's possible. I mean, the other thing is that these are provisional tariffs and there is room for negotiation. So I wouldn't be surprised if there's some changes in the next few months, particularly as some of the companies didn't cooperate with the process. Right. So we'll have to see. I mean, that's just speculation.
But I think that then will feed into the thinking of Chinese firms about how to respond, and the Chinese government how to respond, is that this is not the final word from Europe.
Absolutely. I mean, I wondered to what extent Chinese politicians and clearly business leaders have actually been involved in behind the scenes discussions about this, and they're more or less happy with it. They knew this was going to happen. The key thing was for it to leave margins high enough that the business is still worth having.
Yeah, I mean, the door is because it's a really interesting difference, isn't it? So with the US, they've essentially said to Chinese producers that you will not be entering, you will not be selling in this market. If somehow BYD or whoever could sell at 100% tariff, it's pretty clear that the US would just do something else to exclude them. Whereas the Europeans are saying that there is a future for you in the European market. And I think that probably is something that Chinese firms, but also the Chinese leadership is quite happy to live with, because although there is a number of reasons why the Europeans are doing what they're doing. You know, the big one that really worries, I would imagine, the Chinese companies and the Chinese leadership is this whole geopolitical thing of trying to exclude Chinese products in key areas where chips are important and self-driving cars and this sort of thing. And on the US side, the argument is that there's a security risk about having these cars driving on your streets, and so they must be kept off the streets. And there are some people in Europe who I think would agree with that argument, but the European Commission right now has landed in a place where it's okay to have these cars driving on European streets. They just have to pay more taxes to get them onto the streets to the European Union.
Yeah, I mean, the question about security is hanging over this whole area because it's not been raised very much. There may be some European countries that are concerned about it, but they certainly haven't spoken about it publicly. And they seem currently to be happy to welcome in Chinese firms to produce and manufacture. I mean, they're already doing so in Hungary, and there have been recent announcements that their company's going to start producing in Barcelona and potentially in France, or that's just at the very much sort of planning stages. Now, would you do that if you thought that there was a really serious risk around these connected vehicles, which the US Ministry of Commerce clearly thinks is the case? And is there a risk also that Chinese firms invest in Europe, that becomes a significant business, but then US coercion makes it quite difficult for them to export to other parts of the world, or potentially even creates difficulties within Europe? So it's not, I mean, there are very clear parallels between what's happening in China and Europe now and what happened with Japan and Europe in the 1980s. But one of the big differences is, of course, that there are security concerns about Chinese firms, which they're not about. Yeah, exactly.
But I would imagine from the perspective of the Chinese companies that they will think that the risk that they will be shut out completely from the European market is mitigated to an extent if they're able to become embedded within supply chains in Europe, if they are producing and employing people in France, Germany, wherever. It will be much harder in 5 years' time for the European governments to say, actually, we're excluding you completely.
Yeah.
If they've already enmeshed themselves within the European concept.
I mean, it's already difficult to some extent. They already, Chinese own Volvo, they own MG. The London taxis, it's not in the EU anymore, but the taxis driving around London, which are electric, they're all owned by Geely and made in Coventry. So there'd already be some significant disentangling problems, and it could become much greater in a few years' time.
What do you make of the differences within Europe in this? I was quite struck by these comments that came out after the announcement that you had French car makers and French auto industry people and also Spanish car makers all saying, you know, we're all for free trade and this is an important element to level the playing field. Whereas the Germans just came out straight away and said that this is terrible. We should be open. We should not be putting tariffs up. Is that just nakedly, you know, they're each looking after their own fairly narrow national interest, or is there anything else going on in the difference of opinion?
Well, I think it is mainly narrow national interests, as far as I can tell. I mean, Germany is not just thinking about its European market. I mean, they, as you'll know, they're very invested in China itself, both in conventional cars and also in increasingly in EVs. And Volkswagen has several joint ventures, including with a private firm making EVs in China, and they're hoping to learn from them. So there's now this question about a reverse technology transfer from China back to Germany. They do not want to put those investments in jeopardy and that business model in jeopardy by potentially provoking retaliation by China. So I think that's where they're coming from. France just doesn't have that much investment in China and is also not exporting many cars to China. So they want a more protectionist approach from the point of view of their own car firms, but at the same time, they're actually saying that they'd love to see BYD manufacture in France. So it's a little bit, they want it both ways.
And I think you can see that those differences also reflected back in the way that China has responded. So there's been hints dropped of tariffs on French brandy. For example, there was something earlier on pork imports from Europe maybe being targeted, and I think that's Spain that they're focusing on, and nothing that would hurt the Germans. So clearly the Chinese side are very aware of these differences and kind of...
The Chinese appear to be masters at picking up one side against the other, because it's Europe versus the United States. They want to keep Europe on side. Within Europe, they want to, pick out Germany versus France, and then even further ahead, it's Hungary versus Germany. So they're clearly quite canny in the way they're going about this.
Final question, where do you think this goes then? So we've had these are recommended tariffs or sort of suggested tariffs. They may change a bit. You've got European governments apparently being quite open to FDI from Chinese companies. Where do you think we're going to be in a few years' time?
I think it's very likely that the tariffs remain in place. They may be adjusted in one way or another, but once you've put them in place, removing them is not in anybody's interest to do that. And they're going to get some revenue from it as well, which is always handy. The bit that's really not so clear is what happens about foreign direct investment and whether or not that becomes a really major part of the European vehicle sector. It's quite possible that it does, but that, I think, depends much more on how the geopolitics evolves.
Andrew Kenningham and Mark Williams there on the EU's China tariffs. We're continuing to track this and we'll provide analysis of the situation as it unfolds. If you're a CE Advanced client and have a question about this in the meantime, pop it in the Q&A section of the Advanced platform and we'll get you a rapid response from the team. If you want to learn more about CE Advanced, our premium platform, you can find details on the website at capitaleconomics.com/CE-advanced. Finally this week, the International Energy Agency warned of an oil glut by 2030 as demand peaks. OPEC hit back. It called the IEA forecast a continuation of its anti-oil narrative. So who's got it right? We published long-term energy demand forecasts just over a year ago, and those are accompanied by our interactive long-term energy demand scenario generator. That lets advanced clients model their own GDP and energy intensity scenarios for major consumers, shows you what to expect on the consumption front years and decades ahead. Elias Hilmer from our commodities team recapped our central forecast this past week, and he spoke with Olivia Cross from our US team about what they show in terms of demand peaks. Here's that chat now, and it starts with Elias on the outlook for coal and, of course, oil.
We've all seen those eye-catching newspaper headlines about China ramping up its number of coal power plants and how its massive coal consumption made it the biggest carbon emitter in the world by far. However, while it is true that peak coal is mainly a China story, as China accounts for roughly 50% of global coal consumption, the bigger picture is that China is also adding renewable capacity at an astonishing rate. And we have recently argued that China's coal demand probably peaked last year based on an expansion of solar, wind, and nuclear capacity and a recovery in hydropower. Outside of China, India and other Asian economies will support coal demand in the next decade, but it will likely not be enough to offset the drag to demand from China and from developed economies where coal demand has already peaked a while ago. And that is why we think that global coal demand has probably already peaked last year, in line with the peak in demand in China. Oil, on the other hand, will probably not peak before 2030. And there are a couple of reasons for why we think that is. For one thing, emerging economies, particularly India, still have a lot of potential to increase their oil consumption. On top of that, demand for oil from key sectors such as petrochemicals will also support oil demand, primarily driven by an expansion of that sector in China. On the other hand, we have argued for a while now that the pandemic probably triggered shifts in oil consumption patterns that are set to last. What does that mean? Well, more home working and less international business travel have probably pushed forward peak oil demand. The main drag to oil demand, however, will come from the transportation sector, which, when we exclude aviation and shipping, accounts for roughly 45% of global consumption. While electric vehicle uptake has slowed recently, we estimate that the rollout of electric vehicles will reduce fuel consumption in the US and Europe by around 75% in 2050.
So that's some really interesting views you've got on the different drivers for different fuels. Am I right in thinking you've got a slightly different view for natural gas? You're expecting peak demand to happen a bit later. Can you dig into why that is?
Yes, you're right. Natural gas is quite a different story indeed, mainly because it is commonly considered to be a transition fuel between coal and renewables, and because of its importance in industrial production. And that is why we forecast natural gas to be the last fossil fuel to peak around the middle of the next decade. And similar to coal and oil, the trajectories for natural gas consumption in developed economies differ quite a lot from those in emerging markets. Europe, for instance, has substituted natural gas with renewables only to a limited extent in recent years. It has replaced gas from Russia with supplies from friendlier countries such as the US. In the US, on the other hand, large domestic gas reserves could postpone the phase out of natural gas. And that is why we think that natural gas will hold up better in the medium term. In emerging markets, on the other hand, such as China and India, gas consumption is growing relatively steadily. But, and I think that is the key point here, consumption will remain much lower than it was in now developed economies when they were at similar income levels. This is in part related to low levels of domestic gas reserves and energy security considerations. But more importantly, commercially attractive renewable alternatives could enable emerging economies to transition from coal straight to renewables without relying so much on gas like the now developed economies.
Can you give us an idea on how all of this links into the larger picture for carbon emissions?
Well, sure. A switch towards gas from coal and oil would, all else equal, certainly help to reduce emissions. But if we look at our model, even at the end of our forecast horizon around 2050, global fossil fuel consumption is still far from being insignificant. Certainly, there are some technologies, such as carbon capture, that could also help to weaken or break the link between fossil fuel usage and emissions. But in the absence of large-scale breakthroughs, prolonged usage of fossil fuel underlines our base case that net zero is far from being the most likely outcome at the moment.
Elias Hilmer talking to Olivia Cross about our long-term energy demand forecast. I'll link to the scenario generator on the podcast page and to Elias's note. His colleague Bill Weatherburn had a note out this past week on what US energy resources mean for its appetite for the green transition. I'll add that as well. It ties nicely with Elias's note and with our spotlight work on US global dominance. But that's it for this week. We'll be back next time with Neil unpacking that Bank of England decision, talking the latest on central banks and inflation. And we'll also be looking at the consensus around India's long-term growth potential and much more besides. But until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.